Hey, John.
Hey,
What can you tell us about the new lease accounting standard?
so the new lease accounting standard is going to significantly change the way that we're accounting for leases. I want to start off talking about it's going to be codified under ASC 842. So the new lease standards will be under ASC 842. The old lease standards will be under ASC 840. And there's what you're gonna find is that typically we're used to seeing leases only show up as expenses on the income statement. Well, now the leases are actually going to come onto the balance sheet. You're going to have a right of use asset and a lease liability that are now brought onto the balance sheet.
Great. So we definitely have some balance sheet changes coming our way.
Yes.
When should the implementation begin?
I think you really need to be proactive and get going as soon as possible. From working with our clients, they have different levels of expertise and available people at the clients. So certainly we expect a lot of clients to be able to, when they're doing that first monthly financial statement, that January 31st, 2022 statements. I'm going to back up 1 second. Let's talk about the implementation date, when this is effective. It's going to be effective January 1st, 2022. So our December 31st, 2022 financial statements, those are going to be the first financial statements where this is going to be required. Okay. So ideally, when the client is preparing that first January 31st, 2022 month end, they've already got the pieces in place, and beginning with that statement, they've implemented this new standard.
Yeah, it definitely sounds like you should just be proactive, and we are happy to help.
Yes.
What do our business owners and financial statement users have to do? And I know you already touched on this a little.
Yeah, so those business owners, it's really about making sure the things that we just talked about, getting the resources, getting started, not waiting to the end. It's making sure those sort of things happen, and really, helping out with that timeline of the implementation. For the financial statement users, a lot of financial statement users may have standard ratios and ways that they're looking at financial statements. After they gain an understanding of the lease and what the new statements are going to look like, that's the first part. And then they need to reconsider, their standard ratio analysis, and how they're looking at financial statements and how they're going to adjust for those sorts of things. And then anything, we'll often see, banks, maybe they'll have like a debt to equity ratio, where they, have requirements that the client has to meet. Those agreements are certainly going to have to be looked at and adjusted, to be appropriate with the new standard.
Okay. So with these balance sheet changes, our ratios are likely to change.
Yes.
More than likely. So this is something to be aware of. Can you walk us through some of the key provisions, John?
Sure. I break this down into 7 kind of steps, the way I look at it. The first thing is understanding the scope. The second piece is actually identifying leases. And we'll talk about something called identifying lease components. Obviously, you're going to need to identify the lease term. That's going to be a little bit different than we're used to looking at. You have to determine your lease payments, determine a discount rate, and at that point, it's going to lead to actually doing the accounting, which is going to be, capitalizing that asset, bringing the asset on, that right of use asset, and putting that right of use liability on the liability side of your balance sheet, and then you'll amortize those items to record the expense. So a little more detail. Let's talk about. So the first thing, the scope. This applies to leases of property, plant, and equipment. Okay, there are specific things that it doesn't apply to. Things like leases of intangibles, leases of inventory. It's not those.
And leases under a year.
That's right. That's the other thing, is that you do not need to apply this to leases that are 12 months or less. So we're only looking at leases that are greater than that 12-month period. That's what it applies to. The second thing that I mentioned was identifying leases. Traditionally, there may not have been a real strong emphasis on identifying leases. You kind of automatically think, okay, I know what leases I have. Well, that needs to be rethought and make sure you consider other contracts you have. And maybe there's a contract that actually has a lease built into it that you never thought about before. So you certainly want to make sure you've identified all of the leases that you have. So once you've identified the leases that this is going to apply to, you've got to identify your lease components. Specifically, we're talking about you have within a lease. So let's say that we lease this building. Okay. Well, that's actually may entail more than just leasing the building. Okay. Part of that lease may deal with the maintenance of the building, the cleaning of the building, and those sorts of things. So what you are paying for those services, that's not actually leasing the building. Okay. And so what the standards want you to do is to look at that lease contract and say, this portion of this contract is paying for the building, the right to use this building. Okay. And this other portion is paying for this other, for services essentially. And it's only that portion that's related to the building that would be the lease of your building. Now, you'll see the term in accounting, a practical expedient. That's become a little bit more common recently, where the standard setters realize, okay, that sounds like it may be a little bit difficult to do, and they'll give you options to make it a little bit easier for you. Well, one of the practical expedients available in this standard is that you're not required to identify those lease components, that you could take this building lease and just say, I'm going to treat the entire building lease like it's all for a lease of the building. Mm-hmm. Okay. So now what's going to happen with that is that you're going to have, that right of use asset and that lease liability. It's going, when you get to bringing it onto the balance sheet, it's going to be a bigger number. Okay. So that's a practical expedient available. I expect it will be used, fairly frequently to make things easier.
Yeah, definitely much simpler for our clients.
Yep. So after you identify the lease components, the next thing is to identify your lease term. Mm-hmm. Okay. Now for people that are used to dealing with the old standard, we had future minimum lease payments. You're used to those kind of things. It's going to be a little bit different than that. The one thing that's, so the standards, it talks about it being the non-cancelable period. We're used to that. Okay. But we also need to consider when there are options to extend that lease. And what the standard is going to have you look at is, are there economic incentives for you to stay? Okay. Mm-hmm. So I think that, an easy way to think about this is, let's say you had a 5-year lease for a new warehouse or something like that, and it has, let's say, 2 5-year options to extend. So we're used to seeing leases like that. But what you need to think about is, say in the case a client does that, and then immediately they invest a lot of money in a leasehold improvement to make that specifically work for their business. Okay. At that point, now they have an economic incentive to stay longer. If they get out after that 5-year period and they go somewhere else, they have to reinvest in those leasehold improvements. So you're going to have to look at, how strong is that incentive to stay, and instead of, looking at your lease term as being a 5-year lease term, maybe it extends and includes that 5th option, that first 5-year option, or that second 5-year option. So those are going to be new things that we need to be aware of.
Okay, great. Is there anything else?
So that was after you identify the lease term, then obviously we needed to identify the lease payments. So we talked about that a little bit before when we were talking about the lease components, breaking it up between the lease and the non-lease portion. Once you've determined that, what is included in the lease payment? Well, it includes your fixed payment, okay, and then your variable payments that are based on an index or a rate. So you may have a lease agreement where it's a certain amount per month plus increases in the CPI, the consumer price increase, those things. So your fixed payment, and then whatever, when you enter into the lease, whatever that component that's variable, that is going to be considered a lease payment. If things not to include, if you did not elect that practical expedient and you did split, your lease and your non-lease piece, then that non-lease piece is not going to be considered a lease payment. The other thing that I think you'll run into a lot is where you have variable payments. We talked about variable payments that were based on an index or a rate.
Mm-hmm.
There are other types of variable payments. We have CAM charges, common area maintenance, where perhaps the lessee is charged for, snow removal costs, maintenance costs, and it varies based on actual costs incurred. Okay. Those are specifically not lease payments.
And would you expense those as you incur them?
Yep, that's exactly right. So that as you're using those services, that's when you're going to recognize the expense for those.
Okay. Can you talk a little to the discount rate as well?
Sure. So the discount rate, and we're used to dealing with this. Before we had capital leases that were brought onto the balance sheet, so this isn't completely unfamiliar to us. The discount rate is very similar to how it's done under the old standard for the capital leases. It's generally going to be the incremental borrowing rate for the company, and it was clarified that it's a collateralized borrowing rate. Mm-hmm. So if you were leasing a truck, when you determine the discount rate to apply to those lease payments, you would say, well, if this company went out and purchased a truck and financed the truck, with the truck being the collateral, what rate would there be? Now, there's another practical expedient available to use a risk-free rate. It's only available to private companies. They can use a risk-free rate. So you wouldn't really have to go through an analysis. You could just use a treasury. If it's a 5-year lease, use a 5-year treasury kind of a thing. Now, again, just like the other practical expedient, if you follow those, it's generally going to result in that larger right of use asset and right of use liability.
Mm-hmm. Okay. That's great, though. I'm loving these practical expedients.
Yes, they can make life easier.
Yeah.
So once you've determined that mm-hmm. discount rate, so now you have your lease payments, you've got your discount rate, mm-hmm. and then you're going to capitalize it and bring both an asset and a liability onto your balance sheet. And then you'll start amortizing them off. Well, you're going to make your payments, right? And you'll be paying down the liability, and the asset is going to be amortized. And it's different. I've got two new terms for you. Well, first off is that what used to be called a capital lease is now going to be called a finance lease. Mm-hmm. Okay, so we're not going to use the term capital lease anymore. It's a finance lease, right? So if you have a finance, what the expense is going to be exactly what we're doing now under capital leases, where that interest portion is charged off as interest expense. So earlier on in the lease, there's more expense, right? Because there's a bigger liability, and the right of use asset is charged off straight line. So you add the two together, you're going to have a larger expense earlier in the lease. Okay. For operating leases, those things that don't qualify as finance leases, they are going to actually be considered one item when you amortize it, and they're going to combine them, and it's going to result in the total amount getting amortized on a straight line basis. One thing that we didn't go into yet that I need to mention is how do you determine if you have an operating lease or a finance lease? Mm-hmm. Okay, it's very similar to the difference now. The wording is different in the standard, but I think for most of our audience and most of us, we just need to understand that if something used to be considered a capital lease, it's now going to be considered a finance lease.
Okay. Can you also talk about what the transition of the financial statements would look like?
Sure. So there are some. Again, there's a practical expedient for this one.
Of course there is, John.
And this one I think everybody is going to probably use. Mm-hmm. Okay. Depending on different standards, if you have comparative financial statements, you may run into a situation where you would have to present the prior year's financial statement under the new standard. that you can do it that way.
Mm-hmm.
So if you look at your balance sheet and you say, hey, I want my, if you're doing your 2022 year end and you're like, okay, I want my 2021 year balance sheet in 2022 to be comparative. Okay. You can do it that way, but see, that would mean that you brought your leases onto your balance sheet at January 1st, 2021. And you'd have all of 2021 accounted under the new standard and then all of 2022 accounted under the new standard. Okay. The more practical way to do it is going to be to bring those lease liabilities on at January 1st, 2022. It's going to look a little bit odd on your balance sheet because you're going to have this asset at December 31st, 2022 that's not in liability. That's not sitting on that 2021 balance sheet. So, for a 2-year comparative, that first year it'll look a little bit odd because your balance sheet isn't going to be comparative.
Okay, but 2023 will be fine.
Yeah, 2023 we'll all be used to this and it'll look normal. The other thing I want to make sure that you understand is that, again, when you bring these leases onto the balance sheet,
Mm-hmm.
okay, it's going to be whatever your future lease payments are at that point. Okay, so when we're at January 1st, 2022, okay, so essentially if you look at your December 31st, 2021 financial statements and determine what your lease payments are, wherever you are at that point, those future payments are going to be capitalized and brought onto that balance sheet.
Well, great. Thank you so much, John. Is there
you're
anything
welcome.
else you wanted to tell us?
I think the only thing again is just to remind everybody to not ignore this. We can make we can help make the
Transition.
make the transition fairly smooth. It is going to take some effort, but I don't think it will be a huge undertaking if we get started on it.
Well, perfect. Thank you so much, John.
You're welcome.